Hey guys, Main here. Welcome back to the last episode of the trading course. This episode is going to focus on different styles of trading. There's a variety of different ways that you can trade. I'm going to explain some of them to you, and hopefully the information presented to you in this video will help you determine which style best suits you and your personality, your lifestyle, and of course the amount of time that you even have to put towards trading. First up, we're going to talk about the styles of trading that are based on both the time horizon of the actual trades themselves and the activity in terms of the number of trades being taken. So I break these up between position trading, swing trading, day trading, and scalping. So let's go into each one. So position trading are very high time frame, long-term trades. You're generally going to be catching market cycles, high time frame macro and economic trends. These are trades that are going to be held for weeks, months, even years. So a really good example of a position trade would be buying Bitcoin early on in the cycle, 1 to 2 years ago in this cycle's instance. So let's say you bought maybe in April of last year, and then you're holding this for months and months and months, even years, and hopefully selling somewhere near the cycle top. These are trades that are going to be held on to for a very long time, and they're not going to require a lot of active management. You're not going to be looking at these trades every single day, managing the trade every single day. There's a good chance you will actually only check these charts once in a while. Position trades are generally going to form on the highest time frames, the weekly, the monthly, even the yearly chart. Another really good example of position trades are trades that you might take in your retirement savings account, trades that you're going to be adding to. You're investing in an ETF of the S&P 500 because you believe 20 years from now it's going to be trading much higher. That is a positional trade. So low activity, very long time horizon, focused on catching a market cycle or a long-term high time frame trend. Next up, we have swing trading. So swing trading, in my opinion, is still relatively long-term, and it's going to be holding trades from a few days up to a few weeks, even months. Swing trading is a little bit more active than position trading. Perhaps you're taking a trade based off the weekly chart here on Bitcoin, and you're hoping to catch the breakout on the weekly chart, and you're going to hold this trade for several weeks before closing it out. Now, swing trading is absolutely more active, and you might even start making some decisions based on changes as low as the daily chart. However, it's still a relatively high time frame based trading style. You're not going to be looking at things every single day. You're not going to be micromanaging these positions, and you're not going to be bouncing in and out of trades on a daily or weekly basis. Usually these trade decisions are going to be made on the relatively higher time frames. I would say from the daily chart up to the weekly, maybe even the monthly, and you're going to be looking to hold these trades for the very minimum a few days, in my opinion, and that would qualify it as a swing trade. Similar to position trading, these trades are going to require some patience. They don't require a ton of management or actively looking into the position and fiddling with things. I do believe that swing trading is quite active in crypto, and it is something that I personally do when I'm trying to catch interweek up to, kind of multi-month trends like we've seen, for example, on Bitcoin from the election in November to the end of the year. Those were a very good swing trade opportunity, trying to capitalize on the bullishness of pricing in the US election. So next up, we have day trading. So in my opinion, day trades are going to be trades that are held for a minimum of 1 day. It could be less than a day. You could be in and out the same day, but generally these are still going to be decently high time frame decisions. You're going to be using the daily chart, maybe the H4 chart, maybe as low as the hourly chart. You're not necessarily going to be taking a trade every single day, but there's going to be multiple trades that will play out throughout the week. The term day trading makes sense because there might be a trade that you enter at the start of the day and you're out by the end of the day. There might be a trade that you take near the start of the week and you're out halfway through the week. Anything really between 1 day to about a 7-day hold, I would consider day trading. Anything above that, I think then graduates to that swing trading time frame. Again, this is going to be a lot more active than swing trading and position trading. If you're in a trade that's based on the daily chart and you're executing on a lower time frame than that, you're likely going to have to be watching this throughout the day. You're going to be looking at the chart maybe every 4 hours based on 4-hour candle closes, maybe every hour based on hourly candle closes. So a much more active type of trading that requires a lot lot more attention throughout an individual day. Whereas swing trading, you might be able to get away with only checking the charts once a day, once every few days. With day trading, you're gonna have to be spending a lot more time in front of the screens. Lastly, we have scalping. So I consider scalping anything where you're in and out of the trade in a matter of hours. Once it's held for over a day, that graduates, in my opinion, to day trading. So scalping is going to be a type of trading where you're trading kind of from the daily chart right down to even as low as the 1 minute chart. You're making very quick decisions. You're taking likely multiple positions in the same day. They need active management. You're likely not entering a trade and then leaving your computer. This might be a trade that you take at the New York Open at the start of the day and you look to close it by lunchtime. It might be a trade that you enter below the hourly open and you're closing before that next hourly candle closes. This is going to be the most active type of trading, using the lowest time frames, requiring the most amount of screen time while you're actually in the trade. However, one of the advantages can be if you're in and out of those trades, then you no longer have any exposure. You can step away from the computer and have that peace of mind. So to summarize, position trading is going to be the highest time frame trades. You're looking to catch very large moves and market cycles over multiple weeks, multiple months, even years. Swing trading is going to be slightly less than that. Multiple days up into multiple week type of trading, still relatively low activity, catching relatively large moves. Day trading is going to be anything that you're holding for a day to multiple days, still catching rather large moves, requiring a lot more activity than the higher time frame trades. And then scalping, the most active type of trading where you are in and out, catching small price moves multiple times within a single day. So you're going to need to determine which of these makes sense for you. If you have a job and a lot of other commitments, it might make more sense to focus on the lower activity, higher time frame type of trades. If you have the ability to be on the screen during the most volatile market hours and you want to be in and out of trades and you don't want to hold anything overnight or for multiple days, scalping might make more sense for you. Hopefully some of this information can lead you in the right direction to figuring out which type of trading makes most sense for your lifestyle. So next up, we're going to talk about your reward to risk strategy. You remember reward to risk from a previous video, how much money you're risking for the potential reward on a trade. What we're really going to compare here is having a low reward to risk strategy with a higher win rate versus a higher reward to risk strategy with a lower win rate. Now, what might sound and seem counterintuitive is that you can actually yield potentially the same amount of money with a low reward to risk strategy as a high reward to risk strategy, simply because the lower reward to risk strategy is likely to be a higher win rate strategy. The trades are more probable. It allows you to ignore more noise. But again, similar to the time frames and frequency of your trades, it's gonna all be up to you and your trading strategy to determine what makes the most sense. So over at the breakout terminal here, and I've got the trusty reward to risk tool here. So you can see kind of the difference just visually what these look like. This would be a lower reward to risk. So this is going to be maybe 3 to 1, 2 to 1, maybe even 1.5 to 1. So for every dollar you risk in this instance, you would make $3. Whereas here you're aiming for a much larger reward to risk, right? So here it's a 10 to 1. For every $1 at risk, the potential payout is $10. The likelihood of you catching a 10 to 1 trade is going to be a lot less likely than catching a 3 to 1 trade. A high reward to risk strategy usually involves really tight stops and then targets that are quite far away to allow you to capture 10 times your risk. So they're going to be more common with low win rate strategies. Whereas something like a 3 to 1 or a 2 to 1, the stop loss can be a little bit looser. The target is not far away, which means that your win rate is probably a little bit higher. Now, the best way to actually look at these and give you the information that you want here is through this risk reward calculator. I just typed in risk reward calculator on Google and you get this image, but it's going to give you the math for the percentage of win rate that you need to have to break even based on your reward to risk. So you can see here for a low reward to risk, right? So we're talking 2 to 1, 3 to 1. 2 to 1, you only need to have a win rate of 33% to break even. So how does that math work? Well, if you were to take 100 trades, and for each trade that you win double what you lose. Over 100 trades, you lose 66.666 repeating of the trades. You're down negative $66. But on the 33 trades you get right, you make double that, you're up $66. So you break even. On a 3 to 1, you only have to have a win rate of 25%. So you can lose literally 75% of your trades, but if you win 3 times as much as you lose on the trades you get right, you're still breaking even. So you can see based on how this chart works, the higher your reward to risk, the lower your win rate has to be. On a 10 to 1 strategy, like I showed you on the terminal there, you only have to be right 9% of the time to break even. So this is very interesting information, and it's stuff you should consider when you're going in and fleshing out your strategy. Are you using a strategy that has very tight stops? Are you using a strategy that allows for you to have tight stops and aggressive targets, realizing that, hey, maybe you're going to get stopped out a few times, but when you win big? Or is your strategy going to have wider stops? The win rate likely is going to be higher because you're not getting stopped out, and the targets are maybe a lot less aggressive. So remember, these strategies can potentially yield the same amount of money because there's a combination of not just the reward to risk, but the amount of time that that strategy is going to pay. The actual win rate is going to determine how profitable it is. So use that calculator that I showed you there, combine that with the actual strategy that you're putting together, and figure out what makes the most sense for you and your trading style. You need to think about the type of person you are, the type of trader you want to be, to determine which style of trading makes the most sense for you. So time commitment, how much time do you realistically have to spend in the charts? If you have a regular job, if you've got family and life commitments, that's going to be a factor, and potentially scalping doesn't make sense for you, and swing trading might be a better option. Trade duration. Are you comfortable going to sleep with a trade open? Are you comfortable going on an airplane with a trade open and you might not have any internet? If the answer is yes, then perhaps day trading, swing trading is something that will work for you. If the answer is no, you want to be in and out of a trade very quickly, you don't want to sleep with any positions open, scalping might make more sense for you. Trade frequency. How often do you want to be taking trades? Are you someone who's an adrenaline junkie? You like fast pace, high twitch type of activities where you are going to be in and out of multiple trades throughout the day? You need to be locked in and glued to the trade and the charts while you're in that active trade. Perhaps you're a scalper. Potentially you're someone who likes a more measured approach. You're really good at being patient. You don't have the time or desire to be glued to the screen. You want to be able to enter a trade and then walk away and do other things. Potentially swing trading makes more sense for you if that's the case. Similarly, what is your personality type? What do you enjoy in life and other things that you can kind of relate to trading? Are you someone who needs that fast and quick action? Or are you a more patient and laid back person? That is also going to dictate the type of trader and style that you want to trade. One of my mentors always likened it to running. Are you a sprinter or are you a marathon runner? A sprinter might be someone who likes to scalp and day trade. A marathon runner is someone who likes to swing or position trade. Lastly, the market conditions themselves might dictate the type of trading you need to do. Just because you're a swing trader doesn't mean you can't have period of time where you day trade, and vice versa. The market conditions themselves might dictate how active or inactive you should be. Crypto is a great example of this. When we're in a bull run and there's a lot of volatility, it often makes more sense to be more active because there's more volatility, there's more opportunities available. It pays to be taking sometimes more trades. Whereas a bear market or a ranging market, it might actually make more sense to step away and not be as active and only look for higher time frame opportunities. So these are some things that you need to consider and understand about yourself while you're building out and working on your trading strategy, and then determining what style of trading makes the most sense for you. Last, we're going to talk about actually finding opportunities. One of the best and sometimes worst parts about crypto is just how much there is going on. There's so many different ways to interact with this market and potentially make money. From trading to DeFi to NFTs, meme coins, staking, yield farming, there's so much going on. We're going to focus, of course, on trading. That's what this series is about. So the main way that I think you should be going about looking for opportunities is going to be building a really good watch list. So within the breakout terminal, you can build out your watch list of the coins you want to pay attention to. You can also search for top gainers. Again, you can sort this in your breakout watch list if you like, and you can have it be high caps or just majors or meme coins, right? And then in this list, you might only want to include Pepe, WIF, and Doge and whatever other meme coins you want. So you can do it this way. You can also sort these by the amount that they've changed over the last 24 hours. So if you want to look at what the highest gainers are, potentially the most volatile coins that are going to give you trade opportunities, you can do it that way. There's lots of other tools available to you in crypto. You can use things like Velo charts, and there's tons of information available to you about the market. So these are going to be the 1 week returns based on different buckets of coins, the open interest, different things that you can look at like funding and things like that. There's so much information available to you that you can use to identify opportunities. I also think curating lists on things like Twitter, curating groups on Telegram where you're talking to other traders who maybe are also watching the market and trade similarly to you. Same with Twitter, finding traders you like that are posting useful market analysis, Discord groups. All of these things can be used and can be tools for you to help streamline your approach. So when you sit down at the charts, you know exactly what you're looking for and where to get in on those charts and be as effective as possible with your time. So that's all for this video. Hopefully I've given you some high level ideas on the different types of style of trading and the things that you need to consider so you can figure out what works best for you and you can apply that to your trading strategy. Thank you so much for tuning in. I'll talk to you guys later.